Good evening and welcome to Esquire Group's webinar on undisclosed foreign income and assets, which IRS Amnesty program is right for me. This presentation is for informational purposes only and educational purposes. It's not legal or tax advice, and it shouldn't be construed as such. Everybody's circumstances are different, and everybody should seek individual guidance if they have any issues related to the topics covered herein. I'm your presenter today. My name is Jimmy Sexton. I have a Bachelor's of Science in Business Administration with an emphasis in finance, a JD, and an LL.M in international taxation. I'm president of Esquire Group. We're an international tax advisory firm with offices in Las Vegas, Phoenix, Vienna, Frankfurt, and the United Arab Emirates. We specialize in international taxation. My focus is on tax issues facing citizens and resident aliens living abroad, expatriation, investing, doing business abroad, and foreigners investing in the U.S., as well as undisclosed foreign income and assets. I'm fluent in English and German, and if anybody's interested, feel free to check out my bio. The link is up on the screen right now. So we're going to start off by talking briefly about what the tax requirements are in terms of foreign income and assets of U.S. citizens and residents. So basically, who do the U.S. tax laws apply to? So the U.S. tax laws apply to U.S. citizens and residents. So if you're a U.S. citizen, the U.S. tax laws apply to you. If you're a U.S. resident, then the U.S. tax laws apply to you as well. So there's two different types of U.S. tax residents. One is permanent residents or green card holders, and the other are people meeting the substantial presence test. And essentially, the substantial presence test is a way where you can become tax resident in the United States if you're not a citizen or a green card holder, simply by spending too much time in the United States. And the way you figure out if you meet the substantial presence test is this. Like anything with the IRS, it's not a simple formula. It takes a little bit of work to figure out. So the first step of figuring out if you meet the substantial presence test or not is to figure out if you spent 31 days or more than 31 days in the United States during the current tax year. So if we wanted to figure out if you meet the substantial presence test for 2016, we would first figure out if you spent more than 31 days in the United States during 2016. If the answer is no, you don't meet the substantial presence test. If the answer is yes, then we have to add up all the days that you spent in the United States in 2016, a third of the days from 2015, and a sixth of the days from 2014. If that number equals 183 or more, you meet the substantial presence test, and the U.S. tax laws apply to you much like they would a green card holder or a U.S. citizen. So now that we've covered who the U.S. tax laws apply to, let's talk a little bit about what the tax obligations are of U.S. citizens and residents. So U.S. citizens and residents are required to file an income tax return and report their worldwide income. So this means they have to report their income from anywhere in the world, regardless of where they live. So even if they don't live in the United States, they still have to file a tax return and disclose their worldwide income to the United States. They're also required to file a report of foreign bank and financial accounts, commonly known as the FBAR. This is a filing requirement if you have foreign financial accounts, so basically bank accounts, brokerage accounts, certain foreign pensions, things of that nature, and the combined value of those accounts is $10,000 or more. You would be required to file an FBAR to disclose those foreign accounts to the U.S. It's not a form that creates any tax. It's simply just a disclosure. I have these accounts. This is how much money's in them. You're also required to file what are known as international information returns. These are special tax forms to report foreign financial assets. This is very duplicative to the FBAR, so this would be Form 8938, the FATCA reporting that goes with your income tax return to report foreign bank accounts, brokerage accounts, things of that nature. Also, if you have an ownership in a foreign corporation over a certain percentage, you'd be required to file a Form 5471 to disclose that. The same thing for foreign partnerships, except it would be a Form 8865. If you own a foreign disregarded entity, it's Form 8858. If you formed a foreign trust, you received a distribution from a foreign trust, or contributed property to a foreign trust, then you would be required to file Form 3520A and most likely Form 3520 as well. Passive foreign investment companies are another one. Passive foreign investment companies are basically foreign mutual funds for the most part. Form 8621 is required to report those on your tax return. So the question then becomes, what if I haven't been filing my FBARs or my tax returns, or I haven't done my foreign international information returns? Or what if I filed them, but I made a mistake? Am I going to have to pay a penalty? Am I going to be charged with a crime? How's the U.S. going to find out about this? What do I do? And the answer is that over the past several years, the IRS has instituted several different amnesty programs to help people with foreign income and assets that have been undisclosed or improperly reported to get back into compliance. And that's what we're going to be talking about today. There's basically 5 amnesty programs: the Offshore Voluntary Disclosure Program, or OVDP. There's the Streamlined Foreign Domestic Procedure, the Streamlined Foreign Offshore Procedure, the Streamlined Domestic Offshore Procedure, the Delinquent FBAR Filing Procedure, and the Delinquent International Information Return Filing Procedure. We're going to cover all of these, what their requirements are, who they're designed for, things of that nature. So we're going to start off talking about the Offshore Voluntary Disclosure Program. So the Offshore Voluntary Disclosure Program is pretty much designed for people who intentionally failed to comply with U.S. tax laws. So a typical scenario is somebody had a brokerage account in Switzerland, and they were hoping the U.S. wasn't going to find out. They knew they were supposed to be reporting it, and they just didn't do it. This would be a perfect candidate for the Offshore Voluntary Disclosure Program. To be eligible for the Offshore Voluntary Disclosure Program, legal source of funds would have had to have been invested in the undisclosed assets. So basically, the income that was put into, let's say, the Swiss account, for example, has to have been earned from legal sources. So like wages that weren't reported or something like that. It can't be from, drug dealing or arms dealing or something like that. Those would be disqualifying factors. You also cannot have made a submission under one of the streamlined procedures, which we're going to talk about later. And you cannot be under civil examination or criminal investigation by the IRS. If you meet those eligibility requirements, then you qualify for the Offshore Voluntary Disclosure Program. In order to take part in the Offshore Voluntary Disclosure Program, you have to file or amend up to 8 years tax returns. You have to file or amend up to 8 years of FBARs. You also have to file or amend up to 8 years of international information returns. That's not on this slide because most of the international information returns are filed as part of the tax return. You have to pay any back taxes, interest and penalties, and you also have to pay a monetary penalty of 27.5 or 50% of the highest value of the unreported assets over that 8-year period. Whether the penalty is going to be 27.5% or 50% depends on whether the bank or financial institution where the account was is essentially on a list that the IRS publishes. And the way the penalty works is you look at the 8 years that are included in the Offshore Voluntary Disclosure Program. You figure out the year when those assets had the highest value, and then the penalty is applied to that year. There's also several questionnaires that need to be completed with the Offshore Voluntary Disclosure Program. So this pretty much sums up, who's eligible for the Offshore Voluntary Disclosure Program, what its requirements are. And again, this is mostly for people who intentionally failed to comply. So we're going to move on now to the streamlined procedures. And the first one we're going to talk about is the streamlined foreign offshore procedure. This procedure was designed for U.S. citizens and residents that are living abroad and failed to comply with the U.S. tax laws, but that failure was non-willful. So non-willful is they didn't do it intentionally. They didn't know what the law was, they got bad advice, it was a mistake in the interpretation of the law, something like that. So the first eligibility requirement is, it has to have been a non-willful failure to comply. The second criteria is that you have to meet a non-residency requirement. And basically what this means is that in one of the last 3 years, you have to have been outside of the United States for at least 330 days. If you weren't outside the United States for 330 days or more, you wouldn't qualify for this streamlined procedure. You also have to have failed to report and pay tax on income from a foreign financial asset, and you cannot be under civil examination or criminal investigation by the IRS. The requirements to take part in the streamlined foreign offshore procedure, as you'll be able to see, are quite a bit less than the Offshore Voluntary Disclosure Program. So you'd only be required to file or amend up to 3 years of tax returns and file or amend up to 6 years of FBARs. You also have to pay any back taxes and interest. You'll notice that penalty is not included on that. There's also a certification that you have to file, certifying that this was non-willful behavior, a non-willful failure to comply. The certification must be signed under penalty of perjury, and it includes a statement of facts explaining the circumstances around the failure to comply. And again, there's no penalty. So like the Offshore Voluntary Disclosure Program, for example, had the 27.5 or 50% penalty based on the value of the assets. That does not apply in the streamlined foreign offshore procedure. So now we're going to move on and we're going to talk about the streamlined domestic offshore procedure. This is very similar to the streamlined foreign offshore procedure. The major difference is if you didn't meet that non-residency requirement of being outside of the United States for 330 days or more in one of the last 3 years, but your behavior was non-willful, then you could most likely qualify for the streamlined domestic offshore procedure. So again, this is another program that is available to U.S. citizens and residents who non-willfully failed to comply. So eligibility, as you can see, is very similar to the previous streamlined procedure we discussed, meaning the failure to comply was non-willful. You did not meet the non-residency requirement, so basically the 330 days outside of the U.S. in one of the last 3 years. You must have filed your previous 3 years of original tax returns, and you must have failed to report and pay tax on income from foreign financial assets. And you cannot be under civil examination or criminal investigation by the IRS. The requirements to take part in this are to file up to 3 years amended tax returns, file up to 6 years of FBARs, pay any back taxes and interest, but you'll notice not a penalty on there. You have to sign a very similar certification, basically under penalty of perjury, stating that the failure to comply was non-willful. In this program, the one difference from the streamlined foreign offshore procedure is that in the streamlined domestic offshore procedure, there is a 5% penalty based on the highest value of the unreported assets. So basically, we look at the unreported assets over the last 6 years, we find the year where the assets had the highest value and apply a 5% penalty to that. Now we're going to move on to the delinquent FBAR submission procedure. So this is designed for people who reported and paid tax on all their income, but failed to file FBAR. So a typical situation here is, somebody filed their tax returns, they included all their income, but they just simply forgot or didn't know that they were supposed to file an FBAR to report their foreign financial accounts. If that requirement is met, then they would likely be eligible for the delinquent FBAR submission procedure. To be eligible for this, you have to have reported and paid tax on all the income from your foreign financial accounts. You must have not filed FBARs. You cannot be under civil examination or criminal investigation by the IRS. And the IRS can't have contacted you about your failure to file FBARs. One of the things that I'd like to note here is that very few people actually qualify for this in my experience, because typically what happened is somebody had a bank account that they didn't know that they were supposed to file an FBAR, and that bank account earned, let's say, €2 of interest that was not reported on the tax return. Because all income was not reported and tax paid on it, that person would be ineligible for this program. But assuming that the person was eligible for this program, the requirements are to file the delinquent FBARs along with a statement explaining the reason for the late filing. And this, much like the streamlined foreign offshore procedure, has no penalty. So this is a really good option if somebody just didn't file FBARs, but reported all the income and paid tax on it. So now we're going to talk about the delinquent international information return submission procedure. This is what I touched on early in the webinar, which U.S. citizens and residents are required to file certain forms to report ownership in foreign corporations, partnerships, mutual funds, things like that. So this is designed for somebody who reported and paid tax on all the income, but failed to file the international information returns. If that's the case, then they could qualify for this procedure. They would have to, in order to be eligible, they must have failed to file the international information returns. There has to be reasonable cause for the failure to file, cannot be under civil examination or criminal investigation by the IRS, and cannot have been contacted by the IRS about the delinquent information returns. Assuming those requirements are met, the person has to file all delinquent international information returns, include a statement establishing the reasonable cause for the failure to comply. And as I said earlier, most of these international information returns are included with your tax return, or at least are supposed to be included with your tax return. So usually this procedure would require amending the tax returns that didn't have the international information returns attached to them to properly include them. Finally, I'm going to touch on the so-called quiet disclosure. The so-called quiet disclosure is not actually an IRS sanctioned amnesty program. the quiet disclosure is essentially people trying to fly under the radar, amend their tax returns, or file their FBARs, and hoping that the IRS wouldn't notice. The advantage of this is, as you can see, some of these amnesty programs carry with them some penalties. The advantage of doing a quiet disclosure is you could potentially avoid those penalties. The big disadvantage is there's potentially higher penalties if the IRS does decide to examine the amended tax returns or FBARs that were filed. And you could wind up being a lot worse off monetarily. And there's also no protection from criminal charges. So this really isn't an option for most people. It's better to take part in one of the IRS sanctioned programs. So here's our contact information. If anybody has any questions, would like to schedule a consultation. I also invite you to check out our website at www.esquiregroup.com. Has a lot of information about our services, as well as a lot of educational material like videos and information guides in the resources section. We also have a searchable knowledge base in the customer service section that gives you a lot of information on different tax topics. At this time, I'll go ahead and take any questions if anybody has any. You can just type them into your control panel and they'll show up on my screen. All right, well, if there is no questions, then we're going to go ahead and end the webinar now. Thank you for attending, and we hope you found this informational.